All right, so today we're going to be talking about how to value a billboard business and the different tiers that go into valuing a billboard business. Basically, all billboards, whether it's an individual billboard or hundreds of billboards or thousands of billboards, they're all valued on one metric, and that's called the basic cash flow uh, formula. So basically, all it is just your gross revenue, and then you subtract your monthly expenses associated with that individual billboard or the individual billboards, and then that gross profit or basic cash flow, if you want to call it. That's the metric that you use um, to multiply out by whichever tier those billboards fall into. So I know that probably didn't make any sense to you, but I'm going to explain it right here. So basically, let's say that you have just an individual wooden billboard out in a rural setting. You went out there, you got the permits, you built this thing yourself. You just got some telephone poles, you put them in the ground, you got some treated plywood or something, and you built a sign face. You got some vinyl, you wrapped the sign face, you put rent me. I like this example because they actually put right on here how much they're charging per month, $200 per month. Um, Rent me $200 a month. You can tell they're just out in the field, 2-lane road. They got some barns in the background. So this is obviously a really rural setting right here. But it's got some wrinkles in the ads. Um, Looks like an ad I would put up. Wrinkles are a little bit hard to get out sometimes if you don't know what you're doing. But anyway, it's all good. So let's say he's renting each side for $200 a month. He's got hopefully the other side rented. This side right here is not currently rented, and technically this is two separate billboards. But for this example, we're just going to use one of these. So he's bringing in $200 per month on side one right here. Side two, he's bringing in another $200 a month. So his gross revenue, if he was completely sold out, $400 per month. However, you're not going to be completely sold out all the time. So we got to account for some vacancy. Unless you have solid ad contracts from the last 12 months, the trailing 12 months, and even before that, showing, hey, this is a great location. You're always booked up. But generally speaking, we're going to be putting in some type of vacancy here. So for this example, let's just say 25% vacancy, which equals $100 a month. It averages out to be $100 a month. So his actual gross, once you figure in the vacancy, is $300 per month. Then he's got his reoccurring expenses each month that goes along with this individual billboard. So he's got his land rent. He might be paying 20% or so for land rent. So anywhere from 50 to 60 to even $80 a month, depending on how he negotiated that deal. He doesn't have lights on this board, so no electric, no internet, insurance for this size board, probably not. He might have just normal general liability for his operating business, but if something happens, this billboard blows down or something, he's just going to go out there and rebuild it. He's not going to do an insurance claim on it. So I did put in a sales commission, and the reason why is because if he sells this billboard to a larger company, the person that owns this one probably does not have a salesperson, but the company that's acquiring this billboard probably does have a salesperson. So in the past, it was probably 10% flat rate, 10% sales commission. If you sold something, you got 10%. If you didn't sell anything, then you didn't get anything. Nowadays, it's usually like a base salary plus small commission. So I just put 5% in this one. So his total expenses each month is going to be $100. And bringing in anywhere from $300 to $400 a month, he's going to have $100 in expenses. So his basic cash flow on the monthly, let's include the vacancy, is $200 a month. Okay, so still not bad because how much did this one billboard cost to build? 2,000 maybe. Didn't cost very much. So the yearly basic cash flow is $2,400. So that's still a 12-month or better ROI. Not a bad deal. So I would say if you have anywhere from 1 to 25 of these type of billboards, they're wooden, they're in a rural area. You might have one or two I-beam steel structures. You might have one or two monopole steel structures, but overall it's a small number of structures that you've got, anywhere from 1 to 25. They're going to be trading at like a 4 to 6 times multiple out in the rural area. Sometimes in these rural areas, you can still build billboards. So they may not go for as high of a multiple, because technically you could go down the road and rent some land from the next farmer over and build another billboard if the code allows it. Now, if the code is closed down and these billboards are grandfathered in, you might get a little bit higher multiple. So that's just a case by case basis. But I would say, generally speaking, 4 to 6 times multiple on individual up to 25 billboards in this type of situation, which for these numbers right here is still somewhere between $10,000 to $15,000 per billboard. Keep in mind, you only got a couple $1,000s in building it, and you're getting the monthly cash flow, so not a bad deal. But that's just tier 1. So let's go over to tier 2. Let's say that you're still kind of in the same area, you're in a rural setting, but you are building some really nice monopole structures. You got the catwalks, you've got the safety cables on there. You don't have any wrinkles in your ads. Everything looks really good. This is my buddy Gray down in the Carolinas, Gray Vic. He's killing it. He's got a bunch of boards. He's got like 500 or 600 boards. So he's doing really well down there. And this might be on a 2-lane road, could be on a 4-lane road. But this is a pretty expensive structure to build. I mean, probably talking, $30,000 or something like that just to buy this structure from a fabricator. But let's go over and see what kind of math we're working with on this. Let's get over on this other sheet here. So let's say he's renting these ads for $650 a month. So he's got 2 ads, $650 a month. He's bringing in $1,300 a month. He's still going to have some vacancy just like everybody else is. So let's say 25% is vacancy, thereabouts. And then let's see, just making sure I calculated that right. Nope, I didn't. Let's put in here 1,300. There we go. That's more like it. Anyway, 13. So vacancies, if you're bringing in $1,300 a month, if it's 100% sold out, 25% of the time, you're not going to be sold out. So that equals $325 per month. You got to take off the top. So he's going to be averaging still, $975, $1,000 or so, even counting the vacancy. So land rent could be a couple $100, a little bit over maybe. So let's say he's paying $240 in land rent. Let's say his electric, not much, $25. He might have a little bit of insurance on this structure. He's near the coast, high winds, hurricanes, stuff like that. He's still got a sales commission going on. So expenses $338 a month. Basic cash flow on this structure is going to be $636 per month, and the yearly is going to be $7,635. So I would say this type of structure would go for somewhere between a 6 to 8 times multiple if you only have 1 to 25 structures. And like I said, probably not going to all have steel monopole. You might have some mixed in with the I-beams or the wooden structures. And even this might be a little bit low. These might be, you might get anywhere from 50 to 75,000 for a structure like that. If you got really good 12-month rents going on there. So the last trailing 12 months, you've had it pretty much sold out at least 75% of the time. And then you're re-signing your customers up again for the next 12 months, and they're signing back up. You might get 50 to 75,000 for that structure just based on that. But that's like the first 2 tiers. So now let's say you have those same style structures, but you just have a lot more of them. Instead of 1 to 25, you've got somewhere between 25 and 250. So if you've got that many structures, in the first 1 to 2 tiers, you're pretty much doing everything. You're the owner, you're building the signs, you're selling the ads, you're going out there posting the ads. You may or may not be doing the graphic design. You might have somebody else doing the graphic design, but you're pretty much doing everything. Once you get to 25 to 250, or definitely once you get to be, a couple hundred, you're probably not doing the graphic design anymore. You got somebody by now that's helping you out with the graphic design. You might have somebody in the office helping you out with invoices and things like that. You probably have somebody else driving out to post the ads. You might still be the owner and the general manager and the salesperson. But that's still a pretty good size billboard plant when you're getting to be a couple hundred structures. So I would say that would be somewhere between 8 to 10 multiple. It just depends on what type of location is it in? Is it in a location where you can't build anymore, or can you still build some locations there? If you can build some more locations around that area, maybe on the closer to 8. If you can't build anymore, all the boards you've got are grandfathered in, maybe on the closer to 10. So it also depends on if you have a general manager in place. I think businesses that have most all the seats on the bus filled are definitely going to be worth more versus if you're just still doing everything yourself. So that's how I would kind of look at that. But let's say you take it to the next level and you've got more than 250 billboards. So you've got 250, 500, 1,000 billboards, multiple thousands of billboards. At that point, you're definitely not going to be doing anything with the day to day. You're just going to be the owner, and you're going to have a general manager. You're going to have a salesperson. You're going to have a graphic designer. You're going to have an office person. You're going to have all the seats on the bus filled up. You're just the owner. That's when you can really start getting the highest multiple, which is usually 10 to 14 times basic cash flow. So you basically have to do the same equation. You just have to do it for however many billboards you have. And then you can multiply that by the multiple based on the number of locations that you have. So it's that's a little bit about how that works. Now, the reason why those big billboards companies go for the big multiples is because, well, number one, they're super hard to build. You can't just go up there and build 250 or 500 billboards. That takes a lot of time to build. And once you got them built, all those spots are taken. So you can't even build them anymore anyway. If you come over here and check out Lamar, their stock price is about $100 right now. So once you get to a 10 to 14 range multiple, the companies that are going to be buying at that valuation are Lamar, Outfront, Clear Channel, one of the big 3 publicly traded companies. They're going to be buying at those big time valuations. You might have some large privately held companies, Adams or Link or somebody like that still can pay really big bucks, but you've only got a handful of buyers at a 14 times valuation. Anybody that's an individual investor or a group of small investors, they're going to be looking to get a return on their investment a lot quicker than 14 years. They're not going to want to wait 14 years to get their money back. Lamar doesn't mind waiting that long because they've already been around for 100 years, and they're planning on being around for the next 100 years. So if they can buy a large group of billboards at one time without having to build them individually, and it fits into their current footprint, which is pretty much everywhere, it makes sense to just buy them, pay the man what he wants, and sit on it for 14 years is not that big a deal in the long scheme of things, because they've had a 100-year outlook anyway. So basically, that's going to be your buyers once you get to be that big of a company. One thing that's really interesting here, you come down here to the PE ratio, the price to earnings ratio, 23.73, so almost 24. So basically, and I'll be the first to say I'm not an expert on all this terminology here. Feel free to leave a comment down below if I completely get this wrong. But basically, Lamar trades at a 24 times revenue valuation. So, that's basically twice the amount at what they're going to be buying a local company for. So if they buy a local regional company for a 12 times valuation, they're going to turn around and technically sell it to their shareholders for twice that much. Technically, the shareholders own the company, so it's not exactly how it works, but they can buy it at a 12 times valuation, and all of a sudden it's worth twice that much on the stock market to them. So pretty interesting how it works. Anyway, yeah, if you have any other questions about how to value a billboard business or anything like that, feel free to shoot me an email or leave them in the comments down below. I'm always looking forward to hearing from everybody, and yeah, look forward to seeing you on the next one. Thanks.